Well, welcome back. My name is Hector Hinojosa, and I'm here in our continuing conversation about taxes. The last time we spoke, we talked about RMDs, what they were, where they came from, and how they affect a financial plan and how they affect a financial plan pretty greatly. And so today we're going to talk about taxes in retirement, and we're going to talk about the impact that taxes have. We're going to talk a little bit about Social Security. We're going to talk a little bit about how the tax program works, how taxes work, and then we're going to spend the last part of this talking about um, RMDs, required minimum distributions, and is there a way uh, that we might be able to better handle them. So, taxes in retirement. Um, First thing, let me, we're Swan DFW. We're a registered investment advisory firm. We don't give legal advice or tax advice, although we're going to be talking a lot about taxes. We're not accountants, and so we this is not a recommendation of any kind. This is just some concepts and some ideas that we would like you to consider. We're also not employed by or endorsed by the Internal Revenue Service, the Social Security Administration, or any other agency, federal agency or state agency. Well, we're not, again, CPAs or even accountants or enrolled agents, and we would ask you to visit with them before you take out any of these strategies. And we're not attorneys, but we're going to talk a little bit about the law. I am a certified financial planner. I've been a certified financial planner for about 20 years now. I've been in the business for about 25 years, and so I have a lot of experience, and we'd like to share that with you today. So you're on this phone call or you're on this webinar because you have driving you what we call a rational decision maker. You've made some good decisions. You likely didn't buy the big car or take the big house or spend the big vacation, take the big vacation because you wanted to set money aside for retirement. And so you did that, and that's a very rational decision. That's why you're on a webinar to talk about taxes. But inside of all of us, there's an instant gratification monkey that's our co-pilot, and that's the thing that kind of diverts us from time to time, gets us to binge watch some stuff on Netflix or maybe NFL football or NBA basketball. And the only thing that really kind of controls the instant gratification monkey is the crisis monster. And the crisis monster usually comes in terms of a deadline. And I bring this up because some of the things we're going to be talking about, there's really not a set in stone deadline. There are for taxes, but there's not, you have to do this by this day or you lose it. It's the earlier you do it, the better, or you can go your entire life without doing them, but it does cost you, you'll see, it may cost you a little bit of money. So our goals are fairly simple. We're going to talk about taxes, and we're going to talk about, some of the tax changes and how that might affect you. And again, obviously, how we can minimize the taxes and and um, and still be legal. So first, just talking about taxes in general, the ordinary tax brackets. The more you make, the higher, the more the tax rate is. But you don't pay the same tax rate on all of your dollars. The smaller amount of taxes get paid. You pay a lesser amount. So for the first 19,000, you can see it's about 10%, and then from 19,000 to 80,000, it's 12%, and that's why your net effective tax rate when you do your taxes is always a little bit different. This is how it used to look when we did them on paper. If you're my age, you remember doing your first tax returns on paper, and so you would go through and find how much you made, and then it would tell you the first 19,000 is 10%, and so forth. So that's really how the tax system is working. But in it, there's a couple of times when the tax rate jumps a little higher, and you can see that from at around 80,000 or 60,000, it jumps from a 12% tax rate to a 22% tax rate. And so obviously if we're going to do anything, we're going to try to stay under that 12% tax rate. But for most of us, we're also looking at down the road at around, uh, 200,000. We're looking at it jumping from 24 percent to 32%. So we keep those in mind so that as we do some strategies, we want to make sure that we stay below or try to stay below that big jump to the next tax bracket. Um, Capital gains is also something different than ordinary income tax. Capital gains are something you buy something and then you hold it for a day, for a year and a day, and then you sell it, and then it gets taxed usually at a lower tax rate, and they do that so that we can sell those investments, put money back into the economy. And so in the taxable income that drives the capital gains bracket, under $80,000 in ordinary income, capital gains are zero. Most people didn't know that, but for most of us, it's between 80,000 and 500,000 or 496. The tax rate's going to be the capital gains tax rate is about 15%, and that's what that tax map looks like. We get a standard deduction now. We've simplified the tax code, so we've got a standard deduction of 24.8 for married couples. You get a little more of a deduction we'll talk about when you're over 65. So we keep that in mind as we go through this. The exemptions that we used to have, obviously, or not obviously, but they're gone. So that's a bad thing. But then we also want to talk about a little bit about tax credits. Now, tax credits are a little bit different than deductions because a deduction simply reduces your taxable income. A tax credit actually reduces how much you pay. We're not going to get a health tax credit or earned income credit, but we are going to talk about a little bit about the saver's credit. When you're over 65 and you're eligible to do an IRA and you do that, you get what's called a saver's credit. So we're going to talk about that in a little while. And so just a real simple tax return here. Here's a couple that's gross income. They're married, filing jointly is $38,000. And you get a standard deduction of 24.8. They're both over 65, so you get another 1,300 times 2. So their total deductions are 27.4. One or both of them are working and they have over $2,000 in earnings because they put $2,000 in their IRA, so that's a good thing. So that means that there's $8,600 that is up for subject to tax, which would be a $860 tax bill and $38,000. But because they did their IRA over 65, they get a tax credit. See, different than a deduction. The IRA was a deduction. This is a credit. The IRA reduced the taxable income by $2,000, but here they owe $860, but that credit's $1,000. So that's going to wipe out the taxes due, and so their total taxes due, and this is zero. So that's a good thing. $38,000 may not be enough to live on, but at least it's a goal to shoot for. So the whole idea is that you want to keep from going into the higher tax bracket. Now let's talk about Social Security. Social Security is also taxed, but it's not all of it isn't taxed. Only percentages that are taxed, and how much is taxed is a fairly complicated equation that they use. I'm going to kind of show it to you. We're not going to get into the weeds on this. In our full length workshop, we do get into this, but it also takes us an extra, those seminars go about an hour and a half or so, and we're trying to get this done in around 30 to 40 minutes. So, but just to give you a very high level view of how Social Security is based, it's called provisional income. And then they take 50% of your Social Security benefit, and then they add to that any ordinary income. And now ordinary income in retirement would be money that's coming out of the IRAs or your 401ks or your 403bs or your TSPs or any number of those kind of things, and pensions and stuff. So the 50% of your Social Security benefit plus your ordinary income, add to that all of the dividends and capital gains that you've had or have, and then you add to that your non-taxable interest. That's your municipal bonds that you bought, so you wouldn't have to pay taxes on. You're still not paying taxes on the interest that you're earning on those, but you're having to report that to make it part of your Social Security taxable income. And then for married filing jointly, between 32 and 44,000, you'll pay 50%. You'll pay 50%. You'll pay taxes on half of the money of your Social Security benefit. You're not going to pay 50% in taxes. You're just going to pay taxes on 50% of the benefit until 44,000, and then over 44,000, you're going to pay in kind of a graduated tax rate again. Over 44,000, you'll pay taxes on 85%. So to be simple, if you had $100,000 in income, you wouldn't pay taxes on 100,000. You would pay taxes, if we just made it 85% for simplicity's sake, you pay taxes on 85,000, and then whatever your tax rate was minus your deductions and stuff like that. So you don't pay taxes on all your Social Security, but you are going to pay taxes on some, and that's going to be important here for just. We're going to show you this example. Here's a client who is needing $60,000 a year, about $5,000 a month, into retirement. Both Mr. and Mrs. have Social Security benefits that are $20,000 each, and then they have an IRA that they've rolled all their money to, that they're going to take to supplement to get to the $60,000. We're going to show you this. This is not everybody should do this, but everybody should at least consider this for a couple of different reasons, and they'll become apparent here in a minute. Most of the folks that, and we do it too, you want to wait as long as you can on Social Security benefits normally, depending on your health and those kind of things, life expectancy. Because for every year you wait after your full retirement age, you get an 8% increase in that benefit. So that's a good thing. But you also, depending on where you are and how much you have and how much you're going to need to think about taxes today, and also it may be that taking less out of the IRA might make more sense longer term. Anyway, in this example, needing $60,000 a year in income, how they're going to do it is they're going to take $20,000 in Social Security and then $40,000 a year out of their IRA. And then when you do the provisional income for Social Security, means you're going to pay $11,000. Taxable Social Security is $11,100. You have, of course, the IRA, which is taxable at $40,000. All $40,000 of that is going to be taxable. That gets your taxable income to $51,000. You take your standard deduction. You subtract that out, so that leaves you $23,700 in net taxable income on income of $60,000. So you're going to write a check for about $2,500 for taxes. Now, the thing to consider is we're going to go and still use the $60,000. They're still needing the $60,000, but what we've done here is we've doubled the Social Security. Now Mr. and Mrs. are taking Social Security, which means that they can take $20,000 less out of their IRA. Depending on how much they have in that IRA, that might be a really big deal. So again, each plan is different. There is no everybody should do this or nobody should ever do that, but these are just things to consider as you sit down and start trying to figure out where all the income is going to come from when you don't have a paycheck anymore. So so watch what happens here, because you're taking Social Security and a whole lot less on the IRA. Your total taxable Social Security on this, running through the same formula that we ran, is only $4,000 in total taxable Social Security. Now you have the $20,000 IRA that you took out, and that leaves you total taxable income of $24,000. You take your $27,400 deduction, and that makes a taxable income of $0. And on $0, they take $0. So that's pretty good. Having zero income tax is awesome, and and again, this won't work for everybody, but it is something to look at. and at least run an analysis to make sure that you're not leaving money on the table, because taxes is going to be one of the highest expenses that you'll have in retirement. So any way that we can do to reduce your taxes is more money for you or for your legacy, for your kids, your grandkids. Okay. So if that was the whole tax system, then that'd be pretty straightforward, and we wouldn't need tax lawyers and CPAs and all that. But there's a lot of other things that go into the real tax system, and we could spend a great deal of time going through each one of these. But what we're going to spend the rest of our time is talking about required minimum distributions. Again, in our previous webinar, we did 20 minutes on just those. So if you haven't had a chance to watch that, that might be a good thing. And now we're going to talk about how that impacts and what maybe some strategies might be to minimize the impact on a financial plan going forward. So first thing is we made a deal with the government that said that we weren't going to pay taxes when we were working, that we're going to put money in these plans that qualified for special tax treatment. That's where the qualified plan comes from, the name for that. And then we were going to take the money out after 59 and a half. If you remember, if you try to take money out before you're 59 and a half, there was a penalty, a 10% penalty. But now they also said, but you can't. They don't want you to leave the money there. This is not legacy building money. They want you to take the money out. And they want you to take the money out because when you take the money out, taxes are due. So they want the tax revenue to come from these things. So here's a gentleman that's age 72. He's got $500,000 at the end of December 31st, the previous year. And because he's 72, his life expectancy or his factor is 25.6. So you take the 500, divide that by 25.6, and now he has a required minimum distribution out of a qualified account, not a regular investment. Those things, if you have money that's not in a qualified or a Roth, you don't need to take any money out, but just money in, this man has just money in the IRA, that $500,000 is in an IRA, then he's going to have to take $19,531. Now, if he doesn't take that, we talked about a penalty before, this penalty is 50%. So you really, really want to make sure that you get this right. Here's the factors for those that are not 72, and you actually have a factor all the way to like 0. But you can see that even when you turn 115, they still have a factor of 1.9. So it really is true. You're not going to escape taxes or death. And so we just need to be aware of that, and we need to keep track of that. And that's why most people want to put all their money in one bucket, or as few buckets as we can, so that it's easier to manage. Now, there's some changes in the law that we need to be aware of. And the very first thing is because of coronavirus and that legislation, the required minimum distribution moved from 70 and a half to 72. So if you've been waiting to turn 7 and a half to start taking money out, to be forced to take money out, you don't need to worry about it. You can wait till you're 72. That's a good thing. They eliminated the stretch IRA. So what that means is, in the past, one of the strategies was, if you were going to have money left in an IRA, instead of making your son or your daughter the beneficiaries, because their required minimum distributions, depending on when you passed away, would be higher, you could leave it to their children. And so the grandchildren would pay much less in taxes, letting the investment inside the IRA continue to grow. Well, that's been eliminated. They've put up some roadblocks there. So if you have done that in the past, you may want to revisit that, because it's not going to work the way you thought it was going to work. And then the coronavirus, because the market slipped so badly in March and in April, they decided not to take a required minimum distribution or waive it for all Americans. And so if you're thinking that you needed to take a required minimum distribution in 2020 for the balance of December 31st, 2019, you don't. So that's a good thing. But again, we want you to consider some things here at the end, so don't go away. And then, of course, the tax date was moved from April 15th to July 15th. And that's a good thing. So let's talk about the deal that we made with the IRS. We said, the old Fram oil filter commercial says "pay me now or pay me later." Well, what we told the deal we made was we don't want to pay you now, but we will pay you later. And so we got some tax benefits when we put the money in. We had a deduction in our taxes. We didn't pay any taxes on the growth, and then we're going to take the money out, and that's when we'll pay all the taxes on it. They'll pay me later. When we did that, the thinking was that when we retire, we'd be making less money, so we would be at a lower tax rate, and so you would save the taxes at a higher tax rate when you're making a lot more money, but you would take the money out when you're making less money, and when you took it out, you'd be at a lower tax rate. Our challenge is that with the debt, with the $25-26 trillion debt, up $7 trillion from the end of December. At some point, tax rates may be higher, and so it may not work like we thought. We may have been paying taxes at 20%, and tax rates may be as much or higher in the future. Also, many of you have done such a good job of saving for retirement that when you retire, you're going to have as much or more money in income than you did when you were working. And that's a wonderful thing to do, because you're going to be able to have more money to spend for you and travel and grandkids and all those things. That's a good thing. But it does play, you pay a little higher in taxes, and so we want to consider that here. And if you leave your money in a taxable account and qualified in a traditional IRA or 401k or 403b or any of those other three-letter acronyms, your heirs will have to pay taxes on that money. Now your wife won't, or your husband won't. So if you pass, that money just moves over to them and it's their IRA. But when they pass, then your kids have some rules about how long they can leave the money in before they take it out. And if you pass at 80 and your kids are 50, say, they may be in their highest income earning part of their career. So to add another, 50, 60, 100, 200,000 is going to bump them into the highest tax rates that are there. So again, something to consider. We're not going to get out of paying taxes on this money. The whole idea is there a better time to maybe pay taxes on that? And then so what we're going to talk about now over the next few minutes is a workaround called a Roth conversion. Now, the good news is, as much as you want, you can take qualified money out of these taxable accounts and move them to a Roth IRA. And the reason you'd want to do that is because a Roth doesn't have any taxes due. Now, that's good news. Bad news is that taxes are due on the year you convert it. So if I wanted to take, say, $50,000 out of a qualified plan and put it in a Roth, then I'd have to take that $50,000 as taxable income this year. Okay, so we need that. That's the $10,000 question: is how much can I take out and not jump into a higher tax bracket? That's the play. That's what the whole thing is about. Is there a way to do that and manage my taxes and yet get as much money out of my taxable account into a Roth IRA? And again, the reason you want to do that is if you leave it there for 5 years, then everything is tax-free. And of course, those don't have any required minimum distributions because there's no more taxes. You've already paid taxes on that money. So now, if you need the money when you're, let's say if you did this when you were 70 and now you need the money when you're 80 or 85, you don't have to pay any taxes on that money. That's a good thing. And if you pass, then your heirs don't have to pay any taxes on that money. Now your kids and your grandkids, they're gonna love you no matter what. And if you leave them a little money, they're still gonna love you. And if they gotta pay taxes on the money, they're still gonna love you. But I suspect that if you leave them money where there's no taxes due, they might love you just a wee bit more. Maybe come visit your final resting place more than one time a year. I don't know. But the challenge is, okay, Hector, this makes sense. I want to take money out of that. These are lower tax rates. I want to go ahead and take advantage of that right now, but I don't want to jump into a higher tax bracket. And that's kind of what we're going to get into now. So before we do a tax strategy here at Swan DFW, which is a registered investment advisor, the first thing we want to do is make sure that your plan works, that your wants, wishes, your needs, your wants, your wishes, we've accumulated that. We know what your pensions are going to be. We know what your Social Security benefits going to be. We know what your assets are today. We know we can assume some growth on that. And then we plug all that in and see if the income that you're going to need, you're not going to outlive it, right? Because that's what most of us are concerned, is we start taking money out of these accounts and all of a sudden we run out of money and we still have some life, and that's not a good thing. So what we're going to do very first, once we take all this inventory and figure out how much you're going to need and all of those things, or approximate how much you're going to need, and we're going to run what's called a Monte Carlo. And what this is going to do is it's going to assume 1,000 different random market conditions, market returns over the life expectancy of the plan. And it's really simple. If the last month of life expectancy, if the check is fully covered, so if you needed, say, $10,000 out of that account and it funded $10,000, then it's a pass. It's a green. If you were just $1 short, if that last month was you needed 10, but you could only pay $9,999, even though that's very, very close, it's a fail. It's either a pass or a fail. And when we do these Monte Carlos, we're looking for a grade of around 80. 80 and above are things that we consider viable and things that we can move forward on. But if not, anything below an 80, we want to change. We either want to work an extra year or save a little extra money or spend a little less money, do something a little bit different. So make sure that we get an over 80% probability of success. And the science behind this is really fascinating, and we could spend an hour talking about that, but I'd be happy to give you all the details. So for this particular couple, when we ran the Monte Carlo, you can see that their grade was 92%. That's 92 out of 100 times, no matter what, only 8% of the time the market was so bad that the plan failed. So we think this is a good plan. And so we got to go, we're going to go with this plan. This looks like a good plan. And now we can start talking about, now that we know this works, is there some way to save some taxes? Well, the first thing that we're going to do is see, is there a way to tweak the plan? And for this couple, we did. The only tweaking we did was we modified a little bit of the holdings of how they were investing their money. And when we did that, you can see that just by doing that, not saving any more money, not taking any less money, just doing that, we were able to take the plan from 92 to 96%. Once we get here, then we're ready to start talking about doing some special planning, and you can see there's a whole slew of different things that we can talk about, but today we're going to just talk about tax planning and see if there's a way to save a little money on taxes and make sure that the plan stays viable. So when we do this, the first thing we get is, you can see down here that we can cut off, we can tell the software we don't want to pay more than this amount, and we go all the way to 37%. So we're going to cut it off at 24%. We're telling the software we don't want to pay any more than 24%. That's the highest tax rate we want to be for all of our money. And so it does that. And then when it does that, you can see down here that it cut us off at 24%. When we do it for this plan, you can see that we have saved over the life of the plan, right, until I think life expectancy for this lady was around 94. His life expectancy was 92, and they're in their 60s, I think. You can see that they saved $248,000 in taxes. That's tax saving. That's money they would have had to pay the government had they done no strategy. So $248,000 in tax savings. Where I come from, that's a lot of money. And so that $248,000, that's a good number. Obviously, they wanted to take a really good look at this and actually executed this plan. We'll get into the details of where those accounts, which accounts we use, and those kind of things. But 248,000, that felt really, really good to them, and we felt like this was something that they really should consider. So $248,000 in tax savings really makes the plan worthwhile. But when you save 248,000, the next thing you're going to notice is that they had an extra almost 600,000, because that 248 also, the money that they saved grows, it's invested, and so they're going to leave when this plan is over. When she passes at 94, we're thinking that around $600,000 extra will be left to kids and to grandkids, and a big chunk of that is going to be in this Roth IRA. So without this strategy, all the money was going to be in a tax, or not all the money, but a big chunk of the money was going to be in taxable accounts. Now 3.9 million are going to be left in a Roth IRA, which means that if they needed to use it for health purposes towards the end of life, or if they left the money for the kids, that money is going to come out tax-free. That's a pretty good thing. That's a pretty good thing. But then we have to make sure that once we take this money out and we do this strategy, that the plan still has a high probability of success. Because if you do the plan and it knocks you back under 80%, then that's not a very good plan. And so when we did that, and we did this with the strategy and without the strategy, you can see that the difference is negligible at 96 and 95%. So when we step back and say, okay, so what have we accomplished by doing this? Well, we know that if you don't do anything, you've got a probability of success of around 95, 96%. So the plan, if we do nothing, then you're good to go. But we also know that if you take this strategy, and this couple anyway, takes this strategy and does it, they're going to save $250,000, $248,000 in taxes, and that's got the potential of being another $600,000 in this plan, of more money left to their heirs. Now, this worked out really well for this couple. Your personal tax strategy is going to be different. It will vary, and it'll vary greatly depending on what your assets are, what your income is, all of that's why it's real important to make sure that we talk and make sure that this is a strategy that's worthwhile. We'll do it as a complimentary. There's no obligation, but we do want to have a conversation about that. And so we would tell you now to click the Book Now portion of what it's coming up on your screen right now. We get pretty filled up, and so click now. Let's set an appointment. Let's talk about it. Let's get some information, and let's see if this strategy makes sense. Let's see if the plan that you're considering is viable, and let's just have a conversation and see if this works. It's pretty straightforward. There's no bait and switch. So set the appointment. Let's visit and see if it works. Thank you so much for spending some time with us. We hope that this was beneficial, and we hope that this helps you as you consider retirement planning. And we just pray that you continue to stay safe and you have a blessed day.